Good afternoon, everyone. We'll get started here in about a minute, just letting some more folks add in. So just hold on and we'll be ready to start in a couple minutes. All right, we'll get started now. Looks like we've got no more participants joining, or maybe some stragglers might be coming in. But I want to say good afternoon and welcome to the Foundation for Teaching Economics webinar titled Bidenomics, the President's Plan for the Economy. Today's talk will highlight the new data and trends in the US economy and the evolving policies of the new administration. I'm Ted Tucker, Executive Director of the Foundation for Teaching Economics, and it's my pleasure to introduce our speaker today, Dr. Scott Baier. Professor Baier is currently the chair of the Economics Department at Clemson University. In addition, he's served as a visiting scholar for the Federal Reserve Bank in Atlanta and was also the Senior Economist, President George Bush's Council on Economic Advisors. Professor Baier's interests include understanding the causes and consequences of globalization, the economic impact of free trade, and economic growth. He's also a longtime instructor in our Economics for Leaders program, and I'm grateful for him giving today's presentation. A recording of today's webinar will be available online a couple days after, along with Scott's, Professor Baier's slides will be available online a couple days after today's presentation. We ask that you use the Q&A feature following his presentation to ask questions. And after the presentation, we ask that you'd complete a short evaluation. So Professor Baier, would you like to start?
Sure, and thanks again, Ted, for the invitation. It's glad to be here. I'm glad to be here again. So again, today's talk is going to be on Bidenomics, and this is actually the first time I've given this talk. So if I end up being surprised by any of my slides, it's because I am surprised by the placement of where they occur. But I think we know kind of where we're going now, and what I'm going to try to do is give a kind of both sides or all sides of President Biden's economic plan as he's rolled out so far, and he's had hints at some other things. Of course, there are other things involved in this economic plan, I think, that go beyond just economics when it comes to, in terms of, say, climate, when it comes in terms of energy, in terms of inequality, and when it comes to race relations. All of that's embedded in this, and I'm not going to touch on many of those things. I'm mostly going to just discuss the economic aspects of it. So again, the outline for today's talk is going to be pretty straightforward. I'm going to spend a few minutes talking about where we've been and where we currently are, and I think that's important to know, that aspect and kind of the trajectory we're on, because when we talk about some concerns about President Biden's plans, the trajectory that we currently on, I think, has given some economists pause for concern about what may happen if there's too much stimulus and the economy overheats. And we'll talk exactly what I mean by overheating and why that may occur. So again, we're first going to cover the American Recovery Plan. That's what's already been rolled out, what's in place. Then we're going to talk about the American Jobs Plan. It's called the American Jobs Plan, but it really, when we read about it in the paper or we see it in the news, that's really the infrastructure plan. And so I'm going to detail some of the aspects of that and talk about some of the pros and some of the cons of that plan as well. One plan I'm not going to talk about that much because we don't know very much about it, other than what we think is going to be in it is going to be the American Family Plan, and that will probably be rolled out within the next couple of weeks, maybe a little bit later, maybe in a month or so. But again, we can think of these as the three big aspects I think, what will be the signature programs of the Biden-Harris administration. So the American Recovery Plan really is related to boosting the economy to help us get out of the recession that we were in response to the pandemic. The American Jobs Plan is part of the Build Back Better slogan that he ran on, and the American Family Plan is also part of that Build Back Better plan. And then, of course, I don't think we could escape talking about, just because of the nature and the size of these programs, talking about the implications to the debt and deficit and the implications on maybe future economic growth. So let's start with a little bit of where we've been. I think this is one of the, if you've seen one of my talks before on the COVID economy, I think one of the things that economists have been able to use that we typically had not used in the past was we're now going outside of government sources of data that we would use for macro economy to private sector big data. Why? Because during the pandemic, we really needed good data that was arriving to us daily. And the problem with government data on unemployment or GDP, it was coming to us too infrequently, whether it be every month or every quarter. So this data was put together by Opportunity Insights. If you're I encourage you to go to that website. They have lots of great data. And what I want to first focus on here is kind of spending patterns that transitioned during the pandemic. So we could think of back in the start of January of 2020, what this graph means is it's picking up the percent deviation of, or how much different spending was from early 2020 or late 2019. So again, early on in the year, spending patterns were roughly normal. What we saw occur in early March, at the beginning of the pandemic, was a dramatic drop in consumption, especially in some of the key components that I've highlighted here: arts, entertainment, health and social services, retail, and restaurant and accommodations. Of course, it makes sense where we would see big drops in these categories because these were consumption activities that involve face-to-face interactions or people gathering together in large groups. So what we saw occur in March was roughly, and you can see it here, this represents about a 60% drop in consumption of those categories. Following this drop, as our treatments of COVID-19 got better and as the stimulus got in place, we saw a bounce back in many of these spending categories. So if you look at retail sales now, and I'll show retail sales again a little bit later, a little bit different look at it, we see that retail sales is up roughly 20% from where it was a year ago. So retail sales has bounced back fully. Health and social services are now up about 2%. Restaurants and accommodations are still down about 5%. And again, arts and entertainments, as you would imagine, going to movie theaters, going to concerts, going to other large venues, those are still lagging well behind. They're down about 37%. So overall, what we've seen is a major drop in service activities that involve face-to-face interaction. Again, not too much of a surprise because COVID spread from face-to-face interaction. Going back to government release data, this is nice data put together by Jason Furman and his co-author Powell, where they look at year over year, again, this is actual government data, looking at year over year spending. And what we see is from December of 2020 compared to 2019, consumption of all services was down about 7%. Consumption of healthcare services were down about 5%. Transportation, recreation, food services were down 21%. So a lot of things, again, on the service side that involved face-to-face interaction were down quite a bit. If we look on the other side, the consumption, say, of durable goods, it's not too much of a surprise. Those are up year over year by quite a bit. Overall, durable goods were up. Consumption of durable goods were up about 12%. Motor vehicle parts, accessories were up 7.5%. Furnishings and household appliances were up about 9%. Again, intuitively, this makes sense as we tried to make our home into a home office or a home schoolroom. We bought these additional things in our house, and then recreation goods, since we weren't going to movies, we weren't going out to eat. There was an increase in spending on recreational type goods in the home, an increase in 21.4%. When we add all of these things up and include non-durable goods and services, still total consumption overall was down year over year about 2.6%. And again, this is a big thing. Why? Because remember, consumption is about 2/3 of the US economy. So when consumption falls by quite a bit, we know that's dragging down GDP, or going to be an overall drag on GDP. As we often say in economics, the demand for labor is derived demand. So if the demand, say, for leisure and entertainment falls, so will the demand for workers in that industry. So this is another source of data. It's not showing up on the screen, but again, this is daily data, and this comes from Homebase. Homebase provides us with daily information on hours worked. And these are primarily small businesses. We see a very similar pattern on this. Again, I tried to map these as best I could into the other spending category. But once we see is again a dramatic drop of about 60, 70, and in some sense, like in the case of beauty and personal care, we see a drop of over 80%. And again, and a relatively rapid bounce back, and then things kind of leveled off over during the course of the summer and the fall, and then kind of fell back again as I think as the COVID cases increased in December and January, and where we end up that in retail is actually down by about 11%, healthcare is down about 18%, food and drinks down 23%. Leisure and entertainment's down 25%, and beauty and personal care are down 41%. So again, these are actual establishments, so physical establishments, so where people come in and have to eat. So we see all of these, even though retail overall, in terms of selling goods and services, at establishments, hours worked are down just because we don't have the same foot traffic, or you can't have as many people in as once before. Another area in which we can look at, and we have pretty good data on, that's provided again by Opportunity Insights, is we have hours worked by income group. And it's, again, probably not too much a surprise, and I'll show some additional data on this later, is the income group that was most impacted by COVID-19 in terms of lost hours were the low income groups. Higher income groups, generally speaking, they could work remotely. So the negative impact, even at the worst of the pandemic, it just fell about 13%. And here we see for a while in December of the year, higher income individuals actually had increases in their income, kind of fell back down and now rising back up. And of course, middle income is back to where, someplace in between. Again, what is a pause for concern, or a cause of concern, was for this lower income group as they bounced back, and they were still down 20% in terms of hours worked. When we got around to the middle of November, it fell again. And now we still see their hours worked are down about 30%. And we're hoping this tick back up here is representing a bounce back, or in terms of the Biden economic plan, we hope that the the recovery plan will help those individuals who have been most acutely impacted. So I'll skip that part for time's sake. Going back to data that we, that we normally see, collected by the government, we have weekly claims for unemployment. And again, to kind of just put in perspective how big and how dramatic this pandemic was and how it impacted the employment side. So this is weekly initial unemployment claims. In normal times, these numbers are in thousands. So in good times or normal times, weekly unemployment claims run about 200,000 a week. During the pandemic, in its worst week ever, it bounced up to over 6 million people in 1 week filed for unemployment claims. Again, the biggest filing that we've ever seen. And for a long period of time, up until about we were over 1 million in terms of unemployment claims up until the beginning of August. And you could see where we're at. We're still, even though things are improving, we're still at elevated rates, almost 3 times higher than normal time. So while the economy is improved and while we see some bounce back in certain sectors, the labor market still seems to hasn't returned to a normal level yet. And in fact, when we look at non-farm payroll, and I'll come back and show the slides a few times, this blue line here starting out up until this point here, this is the non-farm payroll in the US, and you can see it's growing at a relatively smooth rate. So what I did was I just extended this line, this growth path out. So this gives us some idea where we should be. What we saw, again, what I was highlighting before, and on the next couple slides we'll highlight in greater detail, we had a dramatic drop of really about 21 million people have lost their jobs within the course of 2 months. And then over time, we've been gaining those back at a relatively, a pretty decent pace, but we're still, this gap from where we were before is still about 9 million. In terms of if we want to look at how quickly this job loss occurred and how the recovery came in place, this chart here shows by industry the job losses in March and April in thousands. So we can see in the leisure and hospitality industry, we lost over 8 million jobs. In education and health service, nearly 3 million. In business, 25 million. In retail sales, we lost over 24 million. Not 24, but 2.4 million. So that was just in the course of 2 months. In the next 11 months, up through this March, we've gained a fair amount of those jobs back. And again, it's not too surprising that a lot of those, that most of the biggest job losses, again, were in service areas that relied on people interacting face to face. So what we see now is the blue lines here, blue bars, I should say, represent the jobs gained over the last 11 months. So in the leisure and hospitality industry, of the 8 million plus jobs we've lost, we've got roughly 5 million back. So we're still only at about 60% where we were as of February last year. In other industries, say like retail, we have almost 80% of those jobs are back. And you can see, if you kind of squint at the data a little bit here, you can see in a lot of these industries, we've got about 2/3 of these jobs back in education and health services, in business services, other services. So again, we're getting the jobs back, but we still have about an 8 million gap from where we were in February 2020. Again, how it shows up in the unemployment rate, we had this big spike up in the unemployment rate, peaked in April. Then from April on, it's worked its way down, and we're currently at about a 6% unemployment rate. Again, I also want to highlight that kind of the unevenness of how this has impacted people. So Wharton has put together this nice data set. Again, this is an official government statistic, but it breaks the unemployment rate down by income and age group. And I think what you should see here is a consistent pattern. Whether you're young, middle-aged, or old, what you see here is that the lower income groups typically have much higher unemployment than the higher income group. So again, this is, I think, about the last slide I have here on kind of where we are and where we're going. I think this kind of helps frame things for aspects of the Biden program in terms of the Economic Recovery Act. Let's get that one. So again, we have these different parts of the Economic Recovery Act. I'm going to talk about each of these, in turn. So again, breaking out what I think is going to be important in terms of stimulating the economy. We have the American Recovery Plan of 2021. The first aspect of it is the emergency relief for individuals and families. So again, the thing that everybody is aware of and was probably checking their online accounts for were the $1,400 per person checks going into everyone's account. Again, what the idea of that is, and some people say, well, that was the pure stimulus of getting money in people's hands, hoping and it would help boost economic activity. Another important aspect of this plan was the additional unemployment benefits of $400 on top of, not $300, but $400 on top of what an unemployed person was getting in terms of unemployment benefits, again, to provide them additional funds. The child tax credit, again, another aspect, and what we'll start seeing beginning in July, as long as everything works accordingly. If you have children under 5, you'll get checks every month, roughly $300 every month. If you have children between the ages of 6 to 17, I believe you'll be getting $250 checks every month. So all of these things we can think of as being income support or stimulus payments going to the household in order to help boost economic activity. In addition to those, we have some of the things that were in the previous acts, like the Paycheck Protection Plan. So the PPP plan is about $7.25 million. There's some additional child care tax credits, some additional loans, small loans available for businesses, and some education stabilization funds, to help with schools. There's an aspect that's allocated to transportation, going to public transport, airports, and Amtrak. And then state and local recovery fund, again, providing money for state and local activity. I think the state recovery and local recovery, half of the local recovery is going to counties, half of it is going to larger size cities. And then there's also some COVID capital projects that are aimed at, again, making sure people can have access to vaccines. So one of the surprising things, I think what we saw last year was that state revenues were surprisingly above what was anticipated or actually grew for many states, but yet their expenditures in terms of making schools safe, in terms of making office buildings safe, were quite a bit high. So they even though the revenues were up, their expenses were up quite a bit. And so the state and local recovery fund is designed to help state and local. And then the last important aspect, and perhaps one of the most important aspects, is the vaccine distribution and health. The economy will not get back to normal and will not recover really until the pandemic is under control, where people again feel safe to go out to eat, go out to restaurants, and travel about. So again, what I'm going to highlight, I think, are the main drivers of this, the recovery plan, are going to be the income support and the stimulus, and how well the vaccine helps in the vaccine rollout and distribution in terms of making, again, a safe environment. To get some aspect of what is of how these income payments are going to people, is you could see really they are the biggest increases in income are being targeted at say the lower income households. So this is your income for between 0 and 10% of the population. This is your income with the relief. And you can see these lower income households are getting much larger increases in their income, say, than median or high income people. Again, high income, you're seeing no boost in income because in general, they don't qualify for lots of the relief. So again, the economic recovery, and the economic recovery plan depends on how quickly people get vaccinated, the efficacy of the vaccinations in terms of adjusting to new strains, what the daily number of cases look like. One thing that I think that's pretty clear in the data that you'll see, I think I'll give a little bit of a glimpse, and you can see people's willingness to go out and spend, to go out and travel is directly related to, or at least appears to be related to, the number of cases that were occurring. So again, as I mentioned before, I would show another picture of retail sales. And again, this is quite surprising. This is retail sales excluding food. So again, the red line represents the trend, and it goes back to 2014. Again, we see that big drop of around March last year. But the surprising thing is we see retail sales really increasing quite a bit. In fact, last month we got the report that retail sales was up almost 10%, much higher than what was anticipated. Again, and it was higher. It was reported at this high rate even before the stimulus package was beginning to kick in. Another important thing that I think is going to help in terms of the overall recovery is where we stand in terms of overall vaccinations. And here's a quick chart that I grabbed from Our World in Data, where you can see the US compared to other countries. And while we're not where Israel is in terms, Israel or the UK, we seem to be in a much better position than, say, Canada, Germany, or the European Union in whole, that we're roughly at nearly 40% of the population that has received at least one vaccine. And again, what I want to also highlight here is to highlight how the recovery is related to the number of cases. So the red line represents new COVID cases, and I'm looking at a fairly narrow time period here. We can see as the number of new cases increased in the US, there was that dramatic drop in spending that we saw back in March. But then as we moved into April and May, as the number of new cases started to fall and the original stimulus package came in, you saw spending kind of bounce back. And then as cases rose more dramatically at the end of the summer, you saw spending level out. So I'm going to leave where we are in terms of the state and the health of the economy at this point, and now focus on the Bidenomics part of that. And again, I guess one more slide to show is looking at Apple's mobility data, trying to track how willing people are to go out, venture out of the home. And what we see is, back in March and April, we saw a dramatic drop in terms of mobility, in terms of driving, walking, and public transport. But then after that, and where we're at now, if we focus on where we're at now, people seem to be quite willing to go out, walk around, drive around. We're up about 40% from where we were at the start of last year. Public transit still way down, as you would imagine. So I'll skip that so we could talk about the economic recovery plan. So what is with the economic recovery plan, and what's important to think about? One is how much of a boost it has into the economy depends crucially and important if how households receive these payments. Initially, I would argue that these payments that households were receiving weren't stimulus. They really were income support or income maintenance. It was a way of the government that was providing social insurance. And so what do I mean by that? I mean that what the government was doing is they were filling in a hole that people had lost some income, and people were spending on things that they would have done already. So again, the question we want to know, or question we have about these the stimulus checks going out and the extra unemployment benefits, is this additional income for people? How are they going to spend it? Are they going to spend it on new things? If so, that's going to be the real boost. That's what's going to boost the economy back up. A way it won't have as big an effect is if these payments are primarily going to be used to pay down debt, or for people to save for maybe for later in the year or down the road. So we're getting mixed signals right now on how these, not mixed signals, but we're trying to pick up now signals from the data, how people are actually using it. And also the other way you would think about it, as I mentioned before, is the payments are primarily going are being used to cover lost income. And I'm just making payments on things I normally had to make, say groceries or other bills. And so I'm buying new things and helping jumpstart the economy. The other important thing is about the economic recovery plan is there are certain aspects that are written in to be temporary, but it's pretty clear that certain aspects or certain groups want these components to be permanent. So again, the child tax credit, plenty of the Democratic side wants a lot of those child tax credits to be permanent. So if you have children between the up until 17, that you will be receiving checks almost forever, as this will be some form of universal basic income. So what already is a large program at 1.9 trillion may get much larger if some of the aspects of income support and income maintenance get permanently baked in. So what I did was I looked at some of the data and I ran some numbers myself. I looked at Moody's numbers. I looked at Wharton's numbers, and I looked at all the outlays where the money was going. And then I kind of then calculated what I would think is going to be the economic impact. And again, just to give you a quick idea of what this means and what I think of the overall impact is. So let's take something about the recovery rebates were roughly $465. And my guess is that about 130 billion of that 465 billion is going to be allocated to increase spending right away. And so that's going to go directly into the economy, where there's going to be 350 billion in unemployment insurance. About a third of that is going to be spent right away and injected back into the economy. So overall, from this roughly 1.9 trillion additional spending by the government, not all of it is going to be injected back into the economy. And what we're likely to see is by the end of the year is roughly $500 billion increase in economic activity. If I was going to do a back of the envelope calculation, that spending alone would reduce the unemployment rate by about 1%, using using Okun's law to think about that. So we would go from 6% to 5% just on that alone. But my estimates are a little bit conservative, so I don't want you to think that that this is the that's the consensus. To give an other side of it, the Hamilton Project, which is a branch of the Brookings Institute, Wendy Edelberg and her co-authors looked at what they thought was going to happen with the Biden stimulus package. So this light blue line represents the recovery if there was no stimulus package. I think she and the Hamilton group are a little bit more pessimistic about the economy's recovery than I would have been. But in her eyes, the Biden package actually boosts the economic activity over the course of the year by about 1.5 trillion. So again, back of the envelope calculation, and in her eyes, the unemployment rate would fall by about 3 percentage points, probably attributed just to the Biden plan alone. And if you look at what the main drivers, her main drivers are roughly similar to mine. You can see this light green area represents that aid going to households in terms of the income support. And again, the other important aspect is COVID containment. I'll say it 100 times, is the economy can't recover until we contain COVID-19. And so if you kind of take all of these things together and what you want to believe, what I want to highlight now is how quickly what would it take for us to get back to normal? And so we can benchmark what happened last month and think that the stimulus package and the natural recovery that we're seeing so far will help us on the recovery. So last month we gained nearly 1 million jobs. If the stimulus package and the natural bounce back and the COVID containment policies allow us to gain back 1 million jobs per month, by April of next year, we will be back on trend for where we would have been in terms of overall employment. So you can imagine then we would have the unemployment back down to about 4%, again, picking back up where we were. If the program is more aggressive, again, the economy recovers faster and the stimulus package is more efficacious, then, and we gained about 1.5 million jobs per month, we would be back on trend by November of this year. And that seems a little bit heroic, but it is possible that the economy could pick up that quickly. If we're more modest in terms of the recovery, that is that the Biden plan doesn't spur a lot of spending, or it's the case that the containment of COVID takes longer than we would, and we only gain 500,000 jobs, we wouldn't return back to trend in terms of employment up until 2024. So one of the big concerns, and I think the economic concerns about I would say the debate is, will the Biden plan, this current Biden plan, lead to overheating, or are economists just overacting? So again, some economists worry, and what do we mean by overheating? Some economists worry that the stimulus, along with the normal bounce back that we're getting as the pandemic as people get vaccinated and the vaccination efforts increase and people are vaccinated and we're opening back up, people are worried that the economy is going to overheat. And what do we mean? In some ways, you can see a lot of this right now, that there's pent-up demand for people to go back out to restaurants or go back to the movie theaters. When things open back up, this pent-up private demand, along with the public push from the Biden plan, along with the amount of monetary stimulus in the economy, will increase demand so much that the economy will quickly reach its production capacity. And if that occurs, that can lead to inflationary pressures, and then we could have high inflation. So it's not, most of the time things like this get attributed to conservative economists, but even economists that have typically advised, say, President Obama and President Clinton, Olivier Blanchard and Larry Summers, they have real concerns that this was such a big stimulus package, along with the trajectory that we are, that inflation is a real concern that we have. Other economists argue that with more than 8.5 million people still unemployed, and we're far below the natural rate of unemployment, and GDP still below, say, its natural level, the risk associated with overheating are low. And there are people that are really out there. There are people out there that are really suffering. So let's go big. Let's try to help people. So economists in this camp are Paul Krugman, Claudia Sam, and again, most people, of course, in the Biden administration. Again, so when you hear these debates in the economic circles of overheating, really what they're worried about is this excess demand and all the monetary stimulus out there, that it's going to lead to inflation. And there's some signs out there I see now in terms of prices rising in certain industries. And I can also see labor markets tightening. A store that I normally go into once or twice a week, I went to go in there Sunday. I was going to put the picture on the slide, but I forgot. It was a Walmart, and actually had a sign on its door that said hiring event tomorrow from 9 in the morning to 11, and then again from 1 to 3. And never in my lifetime have I seen a Walmart advertise that they're having a hiring event covering 4 hours. So again, it means that business has picked up enough in those places and they're having a hard time finding workers. And if that labor market is starting to tighten up, that also means that that's going to put upward pressure on wages and upward pressure on prices. So again, it does seem that there are some nascent inflationary pressures out there, and we're going to have to see whether the Federal Reserve acting in can step in. So again, these economists who believe that we're overreacting when we're speaking of overheating fears, they believe that the Federal Reserve, when they see the signs of inflation, whether that are occurring in the financial markets with longer term interest rates or in other aspects with gold, or whether it's occurring in goods market with gas prices, food, or other things, that they're going to have time to take action and to reduce inflation. Again, kind of a historical way to think about this. Most economists who are my vintage remember, I was young at the time, but I remember the inflation of the 70s and 80s. So there's the younger economists say, you guys, your whole worldview is shaped by the inflation that you lived through in the 70s and 80s, and we don't have there's nothing to worry about. Where economists my age say, oh, you don't realize how bad it was in the 70s and 80s with the inflation. There really is something that we should be worrying about. And once the inflation genie gets out of the bottle, it's hard to put back in. So again, I think if there's a concern economists have about the economic recovery plan, it's certainly not that it wasn't enough. Was it too much? And will the economy overheat? The American Jobs Plan. So this is, what's potentially coming down the road, infrastructure. The American Jobs Plan has different components to it. Part of it is transportation, what we think of as the traditional infrastructure part of that: roads, highways, bridges, mass transit, airports, and then, including things like electric vehicles. It's also going to include things, again, this is where the Biden plan goes in some ways beyond just economics, but also in terms of issues of the climate, which you could argue against, are related to infrastructure. So again, modernizing drinking water, making it safe. I think people would think that's infrastructure. Stormwater drainage systems, improve broadband. Again, it's easy to make an argument that, we should improve broadband, but most schools have, school access to broadbands at 99%. You can get it to homes a little bit better. But again, one of the issues is when we think of broadband and carriers, we think it's quite limited, but there are quite a few number of different broadband carriers out there. Other aspects are things like building up the electric grid. And I'll say a little bit more about those things. In addition, there's energy efficiency and build up. So again, energy efficiency is kind of related to the climate and working on things. The other aspect that's in with this infrastructure is public housing. And now I think that this can be important and be classified as part of infrastructure in the sense of, if we think that these are going to be affordable public housing in urban sectors, making it easier for people to get back and forth to work, opening up potentially more job opportunities, lowering the cost of getting to work and getting home, could actually be part of infrastructure as well. Then aspects to school and human resources, child and elder care. It's not clear to me why those would be ones that fit into infrastructure, but it is part of this plan. And then there's another aspect that's it's quite a big component, almost as big as the traditional component. It's the research and development, the training, and the research and development on the manufacturing side, upgrading research, upgrading infrastructure, working on AI, biotech, and computing. So just say a few things about all of these. Again, the way to think about this as an economist, some of my earlier papers were thinking about infrastructure investment. So again, the objective of this plan is to invest in the infrastructure and make the economy more productive, obviously. In the 1950s and 1960s, we were investing about 5% of our GDP on public infrastructure. Over the last few decades, that's fallen down to about 2%. Sometimes that's made as an argument that we should be spending more on public infrastructure. But again, our economy is much different now in terms of the service sector compared to where we were in the 1950s and 1960s. Investments in transportation infrastructure account for about 25% of the total. And now most economists, most politicians, both right and left, saying, yeah, that traditional stuff, roads, highways, and bridges, I can get on board with that. Even that, I sometimes get a little bit skeptical with, because we make it always use the words dilapidated and broke down. But when I think of airports, I can't think of the last time I left an airport or flew into an airport where they weren't undertaking some new construction project, building something in. Every 6 months or every year I go into a new airport, there's something new and something different there. So I never viewed our airports as being dilapidated. The roads certainly have some potholes from time to time, but there's never a road. And when I drive around all of South Carolina, or I travel back to the Midwest, say, well, that's one road I have to stay away from. The main economic questions, I went on a little bit tangent. The main economic questions coming up with infrastructure are as follows. Is the infrastructure going to be productive? Again, will it, in the sense of, is it going to make workers more productive? Will it make capital more productive? So will it raise the wages of workers, or will this infrastructure somehow be a substitute for workers? I think most of what the Biden plan has is that this infrastructure actually will provide jobs to workers and help boost the wage of workers. Is the infrastructure a complement or a substitute for private capital? And this, again, the question, a different way to state this is, would the private sector have done this anyhow if the public sector didn't do it? And so again, it may not be an efficient thing to do as if the public sector did it. And you can see some of these things in this plan, say perhaps the electric grid or a couple of the other aspects could have been done by the private sector rather than the public sector. Then the other aspect is, from an economic standpoint, the question that we ask is, how is it going to be paid for? One way is, when we think about paying for public infrastructure in terms of efficiency, is, well, who should pay for it? It's the ones who benefit from using it should be the ones who incur the cost. So again, the way to think about it is, if I build a road, well, it should be the people, we should have a user cost or some type of toll for the ones who are using the road the most, receiving the most benefits, should be the ones who pay for it. Another way is in terms of equity, and this seems to be the way of the Biden plan, is that the infrastructure is going to be financed largely by higher income or wealthier individuals. So we're not going to finance things on efficiency ground, but rather we're going to do it on equitable grounds. That is, we're worried about the income distribution, so we would rather have higher income earners or higher wealth holders financing this. And that's fine, and that's their choice. But also remember, when we do this efficiency equity trade-off, there's a tendency when you move more to equity, yes, you'll get more equity, but again, what that'll have is, it'll have a drag potentially on economic growth, because we're giving up some efficiency, and that'll slow some of the growth enhancing benefits. And there's also the last way you can do it, and some of the program will be done this way, is through deficit spending. And of course, I think it's important to watch what happens in this bill as it progresses through and they change aspects of it. Is, will more of the bill be financed by deficit spending as they potentially reduce some on the tax side? So how is it going to be financed? So part of it was to increase the corporate tax rate back up to 20%. Another way in which it was going to be financed is to impose a 21% minimum tax on U.S. corporations to prevent offshoring. Again, this is a way to keep, outside of this is the way to keep jobs in the U.S. Again, thinking, beyond just pure economics, and thinking about income inequality. Limit the way corporations, or the ability of corporations to obtain tax breaks from shifting assets abroad. And then also enacting a 15% minimum tax on book income for the largest corporations that use the profit. Then, of course, the last thing that any plan wants to do, at least on the surface of it, is to eliminate loopholes. And again, especially in this case, they want to eliminate loopholes in tax credits on fossil fuel. Again, thinking about the environment in a broader sense than just an economic sense. So I'm going to focus on the one that probably gets the most discussion. And this is the corporate tax. If we look at currently where the corporate tax rate is in the US, it's this line here. You can see, compared to other countries in the OECD, we're in the middle of the pack. If you look at where we would be once the corporate tax, if the corporate tax would be raised back up, we would be at the upper end. We would be the highest corporate tax rate in all of the OECD. And again, there's a real concern with this. This would be putting it back to where we were before. And there were things that happened, even though when we lowered it, some of the economic benefits that the Trump administration promised would occur didn't occur. There were still things that when I was working for the Bush administration back in 2008, when we had the highest corporate income tax, there were still things that were occurring that we don't hear much about anymore. Back when we had the highest corporate tax rate, we would have things called the Benedict Arnold firms, because they would locate their headquarters offshore so they didn't have to pay that higher tax rate. So again, there are some things associated with that higher corporate tax rate. So let me talk about some of the pros and cons of this higher corporate tax rate. So some of the pros are, if the tax rate is too high, corporations will locate overseas. Again, that's the Benedict Arnold firms. That's what we were worried about back in the 2000s. And that was one of the reasons for many administrations where they wanted to lower the corporate tax rate. High corporate tax rates will cause companies to keep earnings overseas. So again, if I have a plant operating overseas and I have revenues, profits, I may not repatriate those back home. Lower corporate tax rates have a tendency to increase international investment back into the United States. So again, international firms would locate in the US to take advantage potentially of those lower corporate tax rate, again, creating employment, and then lower corporate tax rates leads to additional capital accumulation, and generally think of additional capital accumulation leads to more jobs and higher worker salaries. On the con side, and I will try to wrap up in a couple minutes because I know I've gone over already. On the con side, the lower corporate tax rates in the 1950s and 60s, we know the high corporate tax rates didn't really lead to lower unemployment. So again, when we look at the data, we don't see that strong correlation that people often say is true, that the high corporate tax rates would lead to higher unemployment. The low corporate tax rates can lead to larger deficits, which can lead to higher interest rates and slower job creation. And then one of the aspects that we saw in 2017, 2018 with the lower corporate tax rates, it went mostly to, in some sense, encourage stock buybacks, and we didn't see a boost in employment. The American Families Plan, I don't have a lot to say about it because hasn't really rolled out, but it revolves around childcare, again, families and again, childcare, universal kindergarten, paid family leave, and free community college. When all is said and done, and we've spent potentially $6 to $10 trillion on these packages, and then the question that comes up is, how are these things going to impact the debt and deficit? So if we just focus on the American Recovery Plan, what we see is this additional 3.4, this additional increase in this plan is going to raise the debt level again up to about roughly about 20% of GDP for the year. If we look at the debt, it's going to cause the debt to go up to about 108% of GDP relative to what it was projected to be at 102. And you can see forecasting out over the next 10 years that the debt to GDP ratio is going to rise to about 113%. So again, one of the things that I'll come back to in the next couple slides is that the debt was already on an unsustainable path. And these programs, again, are just moving that timeline along. So I'll skip through this one. So I'm going to go through kind of the three views on the debt. In the coming years, it's going to be unambiguously going to be the case that debt and deficits are going to likely take center stage. And you're going to hear probably three arguments coming from economists. The optimistic view are those modern monetary theorists who say, don't worry about anything. This is a good thing. It's only going to help growth. You're going to have a group that's somewhat optimistic, saying the cost of higher debt may not be that large. So let's do a little bit of spending. and you're going to have the pessimistic view that this debt or higher deficits may result in a fiscal crisis. And so we'll talk with each of these in turn. So the modern monetary theory is no worries, be happy. The United States Treasury borrows in dollars, therefore it can't default. It's not like Greece, we can just print more currency. So, again, how did we, the way to think about it, or how they would want you to think about it, how did we finance the 4.2 trillion we did last year? Well, the Fed increased its holdings of treasuries. We about 80% of it was increased by money getting injected, into banks and into the system. So more generally, modern monetary theory argues you could always find the money. We can print it, to increase federal spending. Just if we need to, we could just go to the Fed. And in fact, Stephanie Kelton, probably the leading proponent or the most visible proponent of monetary theory, says that, the nice thing about, the way we should really think about it is, yeah, we should do deficit spending when things are bad, but better yet, even when things are good, we should act boldly and invest boldly and deficit spend, and we could really improve growth. And most economists don't believe that, and you don't need to necessarily take my word for it. There's a University of Chicago runs a panel of experts of economists across the United States, and they basically ask them, this panel of experts, what are your thoughts on modern monetary theory? Do you think that countries really can borrow in their own currency and really not have to worry about it? And you can see most economists don't agree with that. And when you weight by the strength of their opinion, they really don't think it's a good idea. So that unlimited deficit and unlimited deficit spending is something that most economists don't think that any economy can do, and it's really not sustainable. A more cautiously optimistic view is Olivier Blanchard, who has argued, hey, look, with low interest rates in this environment that we've had with low interest rates, it's a lot less costly to increase the debt or the deficit, because what we have to pay back in terms of interest payment on the debt isn't that hard. So it's going to be less costly at this interest rate. So while Blanchard has argued in the past that higher deficits at low interest rates may be something we want to do, he certainly is not a subscriber to modern monetary theory. And in fact, if anything right now, he's worried about too much stimulus and too much too much stimulus in the economy overheating. So again, what would be one of the problems of overheating? If you have overheating and overheating would lead to higher inflation rate, that leads to higher interest rates. And there you go, that low interest rate world that you live in has just been blown up, and now you got to pay high interest on the debt. The more pessimistic view, and what the slide I'll leave you with, one of the last slide, second to last slide, is the pessimistic view on the debt says the debt that is this high and rising as a percentage of GDP boosts federal and private borrowing costs. It slows the growth of economic output and increases interest payments abroad. A growing debt burden could increase the risk of fiscal crisis and higher inflation, as well as undermine the confidence in the US dollar, making it more costly to finance public and private activity in international markets. So you could guess who an economist is, but this is the Congressional Budget Office who had made this statement in March of 2021. So again, this isn't just one economist, this is the CBO having real concerns, and they've always had this concern of where the debt is, and that we know over the course of the next 10 to 15 years that the debt is going to increase just by the trajectory of Medicare, Medicaid spending, and Social Security spending. These increased spending is just going to put additional pressure on the debt. And then what the CBO argues, and the more pessimistic view is, sooner rather than later, we're going to have to take issues to address the debt and the deficit. So again, concluding, there are several things, important parts of the President Biden and Vice President Harris's economic plan. There's the American Recovery Plan. It's primarily designed to boost the economy out of the recession. The American Jobs Act, and if you want to believe it, and you can believe it is, it's really a supply side thing that is going to increase the productive capacity of the economy. The detractors of this believe that not enough of it is infrastructure, and the cost of raising the funds will be a drag on economic growth. The program that we have next coming down the road is the American Families Plan that'll probably be announced in the next few weeks or the next month or two. And that's going to be another $2 trillion package, again, designed to provide support to families, to help the families, again, get back to work. So that's where I'll wrap up. I'm sorry if I went over. I thank you all for staying on, as most people did, and I'm happy to answer any questions at this point in time.
Great. Thank you, Professor Baier. How much time do you have to give us? About 10 minutes or so?
I have until midnight tonight.
We have plenty of questions.
Okay, then 8:30.
All right, your talk is definitely definitely generated a lot of interest. So the first question we'd ask is from Adam, and Adam is asking, what sectors does Professor Baier predict to have the biggest growth for the remainder of 2021?
Yeah, I really, I think I think it's going to be just from the natural. I'm optimistic of the efficacy of the vaccines and the states opening things back up. And I think there's a lot of pent up demand for people to go back out, go back out to restaurants, go back out to movie theaters. And I think that's going to be the real boost to demand and drive. I'm on board with everyone who's calling for 6.5% to 7.5% GDP growth. I think that's really possible for this year. And when we think about, the industries where unemployment is down the most, it's not like the employees in those industries need a lot of training. So when they pick back up, it'll be pretty easy if you pay them enough to bring them back up. It's not like that they're chemists or something we have to bring in these other industries. That they're lots of skills, easy to fill those jobs. Should be.
All right, we have this is actually a question from Bethany, and it's been upvoted by at least 5 other participants. And so this question is, does the cause of inflation matter? You mentioned that older economists are wary because of what they lived through in the 70s, but weren't the causes of that significantly different than the conditions today?
Well, I think, at the root of the inflation, so again, the initial shock to inflation in the 70s was an oil shock. But again, really what that caused a one-time increase in price. The continuing increase in price that we saw in the 70s was from an increase in the money supply. What we've had to occur over the last year and a half is a large increase in money that's being held by banks, but the banks haven't started to lend it out. We thought back in 2008, inflation might occur because banks were holding a lot of money back in 2008 coming out of the financial crisis. But the one thing that occurred then, the banks weren't in very good positions, so they held most of that money in cash. What was really different about this pandemic is the financial sector was in actually very good shape, and they still are in good shape. So there is a concern of economists that when demand takes off, banks are sitting on a lot of vault cash, so to speak, and there'll be consumers that want to borrow money. And once that money gets into circulation, that's what causes inflation. It's the same thing that caused inflation back in the 70s as well. Just too much money chasing too few goods.
Okay, here's a question from David, and he's asking, who is the Biden administration going to make bear the cost of the stimulus package? What will be the long-term implications of this on the economy?
So again, the long-term implications on the economy will be, it's potentially on, will it cause inflation? Will it cause the economy to overheat? Alternatively, it'll be who has to pay the taxes. Again, eventually the debt, in some sense, some aspects of the debt and deficit have to be paid off. Taxes will most likely have to increase on some groups, some individuals. And if I was a betting man, I would say it would be higher income individuals later in the Biden administration will have to pay the burden of the higher taxes. So there'll be a tax in two ways. That either we'll have an inflation tax or potentially down the road, higher income taxes on certain individuals. Good question.
This is another question from Bethany that was, again, upvoted by another 4 or 5 participants. And this question is this. She says, I've seen data that shows that areas of the country that have the most economic activity tend to be blue, coastal states and big cities, for example. The areas of the country that have the lowest vaccination rates tend to be red. How do you see this connection playing out in the terms of economic recovery, but also in prolonging the pandemic?
Yeah, so that's a good question. So one, the most economic activity is concentrated, not concentrated. It's going to be in some of these large urban areas just because of the pure density. In terms of the vaccination, you know, I can speak of myself. I live here in rural South Carolina. I have to go out of my, I am vaccinated, but even so, even if I wasn't, I really have to go out of my way to run into somebody. Whereas if I'm living in New York and I want to venture out of my apartment or I'm going to run into someone very easily. So I think it's important that they have a higher rate of vaccination than they would in the South. But I think, you know, when you look at the geography of how things are opening up in economic activity, where things are opening back up and where they have, I think as things loosen up, I think you see the growth occurring. So I'm not so worried about, you know, what I suspect, and I'm not giving a coherent answer as I would like to. The one thing I think what we're seeing here, and I'm observing it, you know, in the rural South and other areas I travel, that there is a desire for most people to be vaccinated, and that's gonna be the key. And as long as people continue to get vaccinated, things will open back up, and economic activity will get back to where it was. But it's more important for vaccination to occur at a higher rate in the large cities.
Okay, so
well, Clemson have a football stadium. They're supposed to. I saw that pop up.
I have a question from Kristen, which actually is, we wanted to ask something similar. And she's asking, are there concerns from the administration looking at the housing market? How does the housing market play into our current economic growth? She says, I live in the suburbs of Atlanta, and in our area, housing prices are skyrocketing. And I would say that in Davis, California as well. Houses are easily sold in less than a week with multiple bids. Should we be concerned about another looming housing crisis?
Yeah, so that is something. As well, part of it is as people are moving out of the city. As people have discovered, they can work more easily remotely, or they're going to be allowed to work more remotely, that they move to the outskirts of the city. Even in South Carolina, where I'm at, I live just outside of Greenville, and then in other areas, we live by nice lakefront properties. Houses are getting bought up quickly. The one thing I could say is this is where we're potentially seeing some of the inflationary pressures. If you look at lumber prices, probably related to housing and housing construction, lumber prices are rising dramatically. So again, I think this pent-up demand, this demand for housing, demand to move out, may be one of the early indications of inflation coming down the road.
Okay, great. Thank you, Scott. All right, we'll do maybe just 2 more questions. I know we're starting to impose on your time there. But we have a question here from Martha, and she's asking, can you simplify by giving me a, quote, multiplier number? I ask because I teach AP Econ, and we are told to teach spending multipliers of 10 or 5 or 4. What should I tell my students?
Wow, those are big. Well, 10, 5, and 4 I think are good ones because they're easy numbers to work with. It's 1 over 0.1. So, you know, so what I would I encourage, what I would do is a nice place to go, and I think they lay it out pretty nicely, is type in the Wharton model, Google it. They have a nice 1 or 2 page report on it, and part of it comes from the chart I put up earlier. Is they report multiplier numbers for what they believe is in this pandemic. And they do high multipliers and low multipliers. And surprisingly, given your numbers that you've given, all of their multipliers are less than 1, that they think during this pandemic. They think for $1 spent, or $1 of government outlays, the impact on the economic activity is going to be less than $1 additional dollar. And I'm consistent with that. My numbers that I presented, my multiplier was about 1/2. The numbers that I talked about, Wendy Edelberg's numbers, her numbers were about 1 to 1, that the government multiplier was for every dollar increase in the economy, GDP would go up $1. I'm a little bit more pessimistic, but Google that Wharton model, then do economic recovery plan, and it should take you to that PDF that has their multipliers in. It's a good, easy read for your students.
All right.
There it is, budget model.
Okay, last question for you, Scott, although there was one question that said that you should come back in 2 or 3 weeks once the plan comes out and is passed.
Sure. Happy to.
So there's a question from the last question for you from Michael, and he's asking, let's say the pessimistic view of the debt turns out to be true. What kinds of steps do governments have to take under those circumstances? What changes would you expect from policies to Americans' daily life? Yeah,
so I think the pessimistic view, I mean, I'm not predicting the end of the world where we have Godzilla versus King Kong, but it would be, I think, the view in which we have to take, I think the view is, what I would anticipate occurring is, in the next 10 years, what you're likely going to see is an increase in taxes. It's going to be an increase in taxes that is broad-based. It's just not going to be on the top 1%, 5%. Everybody is going to have an increase in taxes. The second thing that is likely to occur is the benefits that we receive from either Social Security, Medicare, or Medicaid are going to need to be cut. And there's one other option that could possibly happen. One of the biggest drivers of the increase in Medicare costs are, one, the number of people who are moving into the age of Medicare, but also the rising cost of healthcare. If something that would occur that could bend that cost curve down, that could help. But in general, I think what we're going to probably experience is probably an increase in taxes and a reduction in benefits. And you can see now why government officials, why we haven't had any action on the debt. It's really hard to win an election by saying, vote for me, I'm going to raise your taxes and reduce your benefits. So I guess that's the last line I'm going to have for the day, unless there is another question. I thank everybody for staying on well beyond an hour. This is my first presentation of doing this, so I apologize for it being a little rough. And as always, I thank the Foundation for Teaching Economics for giving me a venue to talk about economic activity or economic policy as it hits the road.
Great, thank you, Professor Baier. And we just ask all the participants, thank you for attending and listening. And we encourage you to please fill out a survey on the presentation, just so we can continue offering these. And certainly we'll take the suggestion of inviting Professor Baier back in a month or so. As the economy seems to be changing pretty quickly, and I think he's, of anyone, is right on top of it. So thank you, everyone, and have a great evening, and thank you for joining us.